Hello. In this video, I want to talk to you a little bit about the sort of the long-term planning process for financing and the long-term financing choices that you have. It's probably not correct to say that it's a long-term financial planning process. It's Financial planning is something that you do on a regular sort of rolling basis, and then you have to make the decision whether or not you're going to meet those financial needs with long-term financing or short-term financing. So, first learning objective that we have here is that I would like you to be able to describe how a firm would go about developing and executing a final financial plan. And so that should include some description of how it goes about figuring out how much capital it needs, so how much money it will need to raise and when. An explanation of the alternatives available to the firm in terms of meeting its capital needs, the factors that contribute to their final decision on funding, and just at a high level, the actions that they would then take to implement the funding decision. So let's start first with just kind of looking at an overview of the financial planning and execution. It's actually pretty simple. You're going to develop a capital forecast, and I call it a long-term capital forecast, meaning that it's not intended to just go out for a month or two. Usually you're going to try and look out as precisely as possible for the first 12 months, and then you may want to review additional funding needs that you may need over the next 3 to 5 years. The idea there is sometimes you may not need a certain amount of cash exactly in 12 months, but you're going to need it, say, 18 months or 24 months from now, and it's a sizable amount. And so it potentially makes more sense for you to start the process of raising that money now and maybe doing it in issues of stock and equity and so forth than it does to do a little bit here, a little bit there, a little bit along the way. For a variety of reasons that may just be more efficient for you. So that's why you want to be sure that you're looking ahead. Similarly, I know that in some of the business simulations that we've done, this is evident. Your ability to raise funds in any one period may be limited. And so if you're looking down the road and thinking 2 or 3 years down the road, we're going to need this big pot of money for something sizable. Maybe we're thinking about acquiring a company or something like that. You may want to build up that funding, the availability of that funding over time, possibly with multiple issues of debt or equity, rather than going out and trying to get that one big capital raise all at once. Sometimes that's cheaper. So at the end of the day, the first thing that you would want to do is develop that forecast. Next, you would want to look at what your funding alternatives are to meet the capital needs that come out of that forecast. And so in that sense, you're going to find out how much can you raise and what it will cost to raise it. Once you've done that, then you have to come back and basically compare that again against what your budget was, your forecast was, and make some decisions. And so those decisions may be, very easy. It looks like we can raise as much money as we need, and that it's going to be at a reasonable price, and so we would move forward. Or it may be that we can't raise as much as we would like to raise, and we need to think about maybe trimming back the amount that we're going to spend. And so that would sort of close the loop by going back and saying, I understand that in your forecast you've got a lot of things on your wish list that you would need capital for, but quite frankly we don't think that we can successfully raise as much capital as you want, and so you need to go back to your wish list and prioritize it and trim it down. And then lastly, of course, is executing that plan, taking the steps to raise the amount of money that you said that you needed to raise. So if we go through that and think about each of those individually, let's first start with the forecasting. So, of course, it starts with In my view, it starts with understanding how much money you think you're going to need in the future for, call it non-operational things. And so for either you're going to make changes to your accounts receivable and inventory, or you're going to make other investments, sort of building up, if you will. Usually we think of taking this money to build up assets on the balance sheet. And so again, you might say, well, we feel like we need to hold more cash, we need to have a larger accounts receivable, we feel like we need to hold more in inventory, or maybe purchase plant and equipment or businesses or whatever else. And so those become sort of your investment needs. Now, in reality, there's a flip side of that. It's not always just the investment needs. You may see, for example, that, we've got a liability that is coming due and we need to make sure that we have cash to pay that off, whatever the balloon payment or maturity payment is at the end. And so you would want to put that in there too. So it's not really just investments, as we say here. It could be whatever cash needs. And then you need to evaluate how much cash you have. Obviously, you have a certain amount of cash in your accounts right now. If your needs are small and you have a large cash balance, that by itself may be enough to take care of everything. And so you're effectively funding from your reserves. You don't need to go out and raise any money. Similar to that, though, what you need to do is you need to forecast what your cash flow from operations over the next period of time will be, because for a couple of reasons. One is it's possible that your forecast is not good, and you'll actually have to use some of the cash that you have because you have negative cash flows from operations if you were to forecast those. Or it could be that you expect to get a fair amount of cash flows from operations, and you plan to use that, and that would reduce the amount of external funding that you need to get. This is probably, if you think about it, how much you want to invest. There's some uncertainty sometimes about how much things are going to cost, but that variability is relatively low. You know exactly how much cash you have. This process of forecasting how much cash you're going to get in the future, that's really the challenging part, if you will, of developing the capital forecast. Simple way to think about that is, we may have a plan that says, over the course of the next 3 years, let's say in our forecast, we think that our sales are going to be this much, and our profits from that are going to be this much, and our cash flows coming out of that actual cash, not just accounting earnings, is going to be a certain amount. And based on that, we think we've got enough cash and we don't need to go out and raise funds. Well, how far off can your sales estimates be? Remember that how much you sell is both a function of the changing wants and needs of your customer base, and changes in what your competitors do in terms of meeting those wants. And if they start doing a better job of meeting the wants than they have done in the past relative to you, they'll take away some of your sales. Now, so it's one thing if you take away my sales, but keep in mind that companies then build inventories to be able to meet the sales that they have. And so if you build up these inventories but don't have the sales, you've got cash going out to pay to build up the inventories, whether that's labor costs or whatever else. But you've got these cash flows going out to build up the inventories, and you don't have any cash coming back in to cover that from revenue. And so as a result of that, you can find yourself unintentionally having more inventory than you thought you would have, which consumes cash, and therefore less cash than you thought you would have from revenues. And so, at the end of the day, there's a fair amount of uncertainty under that. Now, the key to that is that what you want to be able to do is sort of identify this really remember that the finance function's job is we have to have enough money. we shouldn't have just way too much, more than anybody would ever think we could reasonably use, but we can't run out of money. And so you basically have to put together not a likely case forecast for cash flows from operations, but maybe a worst case forecast, or a bad case. Let's just say. So, maybe if you thought about it from a probability standpoint, you might say, look, what's the amount of cash flows we might see where there's only a 5% probability that we would do worse than that in terms of cash flows from operations. And so you really need to think in terms of sort of that worst case, and set up that scenario and build your cash budgets around that. That's you will sometimes wind up with more cash than you intended, but using that approach, you would not run out of cash. And so that's what sort of creates, a lot of times people think that companies intentionally plan to have these big cash balances in their cash accounts. And in fact, a lot of times it isn't an intentional thing per se. It is that that cash balance represents the difference between what they thought their worst case cash flow from operations would be and what actually happens. And so it just sort of happens by virtue of this need to be very conservative in your estimate of how much cash flow from operations you're going to get, and hope that you are pleasantly surprised and you get more. Keep in mind that you can go out and raise funds based on a worst case cash flow from operations estimate, and if things come in better, you can take some of the cash flows, that extra cash flow from operations, and pay down some of your financing. And so you can always reverse out of some of that financing once you're sure that you don't need it. Second thing, once you've sort of built out that forecast, so we have estimates of how much we need, we have a amount of what we currently have, we have estimates of what we might get in the future from operations, then we can establish sort of our funding target, and that basically is, how much cash would we need given that picture in order to not run out of cash and satisfy the requests that we have. So in a nutshell, that's that first step, and I probably talked about it a little bit more than most would talk about it, but honestly, it's generally ignored or simplified quite a bit, and it is the single biggest determinant of what comes next. So once you've got that, you move on to looking at your funding alternatives. Most people think of funding in terms of debt and equity. They miss the other category. The other place that you can always, you have the opportunity to raise funds is from asset sales. So if you have poor performing assets, let's say that you've got something that you bought it some time ago with the belief that it was going to generate a certain amount of profits, and in fact it's not done that. It has not lived up to your expectations. Then you have the ability to reverse that decision if you want, and just sell those assets off. They're not doing what you thought they would, and the money that's tied up in those assets could better be served with the new projects that you have coming on. And sometimes that can be a sizable amount of your funding. So it's an important step from a financing standpoint to first look at that. It is your single best source of funding. It doesn't cost you money per se. It actually saves you money because you're avoiding the poor performance and the costs that you're already incurring for those assets. And quite frankly, what they look like. Let's say that you have a non-performing asset. You have a piece of equipment or a building or whatever that you thought you were going to use. Turns out you're not going to use. It's just sitting there idle. From an investor standpoint, that's like a big bag of money sitting in the middle of the floor doing nothing. Number one, they're not going to be happy that it's sitting in the floor doing nothing, period. Number two, they're really going to be unhappy if you leave that big bag of money sitting in the floor doing nothing and turn around and go raise a whole bunch more money. They would like you to take that bag of money and use it first before you go raise more money. So that's kind of the most overlooked source a lot of times when people are thinking about funding alternatives. Uh, Once you do that, then you can go out and look at your debt and equity, and what potentially you might be able to raise from that. Right now, those let's take debt first. Debt is usually raised through bonds for corporations. And so you can generally get some idea, both, keep in mind that from a bond standpoint, that oftentimes if you're going to go out and raise more debt, the existing debt holders might have some opinion about what's acceptable in terms of, any additional debt that you put on. So they may put some limits on it. But the market will also impose its own limits, and in terms of what it thinks is a reasonable amount of debt before you become too risky. And so you can basically go, this is where we really use investment banks. We go to them to sort of test how much debt can we issue, how much money could we raise from it, what will be the cost of that, and that plus sort of our lawyers telling us what our agreements on existing debt limit is to, will allow us to arrive at an amount of debt. Sort of the same, you can also use investment bankers for floating an equity issue. Now, there's generally not the same sort of issues with going out and floating more equity for a public corporation, publicly traded, listed, but sometimes there are some dilution restrictions that existing shareholders might have related to new equity issues. And so they may require that you, for some class of shareholders, that you maintain their stake in the company, and therefore while you can go issue more equity, some of that basically has to go and maintain their share of the company. And so that can be a little bit tricky, and you have to factor that in. But otherwise, you basically would go out to your investment banker and talk about realistically how much money you could raise from equity, and they'll go through the same sort of evaluations of what's allowable and so forth. So at the end of the day, in that step, you're going to have money that you could get from the asset sales. That's going to be an approximate number. Money you could get from debt, again, an approximate number. Money you can get from equity, an approximate number. All of those based on, if we were to do a transaction, what might we raise? It's not 100% guaranteed. And so you're going to want to take sort of a conservative view on that as well, because you don't want to go forward like you have a funding plan that you're definitely going to be able to raise a certain amount of money and then find out that you raised less than that, and you now don't have enough for your budget. And so based on that, you simply compare the amount that you could raise through those sources to the amount that you think you can need, and you can figure out, do we have enough or do we not have enough? And so this is where this final step before you execute comes in, is you may look at your funding from those three sources and say, we've got more than enough funding sources to meet our investment needs, and the cost of the funding is acceptable for the investments that we want, and so we're going to move forward. Or you may say that, well, we cannot raise as much money as we want to. It's just not available out there. Or when we put together the pro formas of what our financial performance will be after we raise that money, we don't like how it looks. So for example, if I start adding debt and assets, all of that to the income statements and roll those forward, and so I'm adding the interest expense from the debt plus the additional depreciation from the assets, and when I include those in the income statements and run those pro formas forward, I wind up running a loss. That's not good. And so basically, it's possible for you as you combine all of that to come to the conclusion that the debt is too expensive. We shouldn't be making this investment now. Quite frankly, if by theory at least, and there are sometimes some exceptions to that, but if your capital budgeting analysis says that the investment was a sound investment, and you reflect the same assumptions in your pro forma income statements as you do in your capital budgeting analysis, you should not come up with a result here, assuming that you used the right costs of capital and so forth. You should not come up with a result that says, we thought it was a good investment, it still looked like a good investment after we included the estimated costs of funding, and yet when we run our pro formas, it's no longer a good investment. That's not what I'm talking about. What I'm talking about here is maybe it looked like an okay investment based on some assumption about funding, but when you found out what the actual funding was, it's no longer a good investment. The capital budgeting metrics tell you it's not a good deal, and so you would cancel it. And so that would be an example of in this loop where once we know the information about costs, we may choose not to go forward with some investments. That's going to reduce the amount of funds that we need, right? So that's one possibility. The other possibility is the funds are fairly priced, and it still makes us want, based on those prices, we would still want to do all those projects, but we just can't raise enough money. I know that financial theory says that it's never a question of enough money, it's always a question of cost, but the real world doesn't necessarily work that way. There are people who are willing to provide you funds up to a certain point, and beyond that, they're just not willing to do any more at any cost. And so, you can come back around and basically say, well, turns out we aren't going to be able to do everything that we wanted to. So you would go back to your forecast, you would trim off, you'd sort of prioritize your investment choices and trim off those that, maybe are your poorer performing choices, or, depending on your strategic priorities, maybe they're lower priority or whatever it is. But effectively, you would have to make the decision to trim your investment plan a little bit. And once you've done that, then you can sort of finalize the funding plan. And so then that funding plan, you would generally finalize the amount that you think you're going to do in asset sales, and then you would figure out what's left that needs to come from debt and equity, and you would have to determine how much you're going to get from debt, how much you're going to get from equity. Again, that is under the assumption that that you're able to raise more money than ultimately what you need. Obviously, if you can barely raise enough money through whatever you think you can raise from debt and equity, oftentimes you wind up just saying, well, give me the max amount of whatever debt I can get and the max amount of whatever equity I can get. And so not so much of a determining a mix as the market determines it for you. But if you find yourself in the fortunate situation where your funding needs are less than the max amount you could raise in the market, then you now have the choice of, so do I lean more on my debt or do I lean more on my equity? And the next discussion that we have, we'll talk a little bit more about how you might think about that. And so then once you've finished your plan, you have to execute. So the first thing you generally do is you execute your asset sales. You do that for a couple of reasons. One is that's usually a fairly quick process, and you want to nail down exactly how much you get from the asset transactions. And then you go out and issue the debt and equity on top of that. Now, again, one of the other reasons you might want to do the asset sales first is that if you have truly poorly performing assets, you want to be able to tout the fact that you are unloading those and doing a good management job, and that you expect your overall return on assets to be going up when you go out to the market looking for debt and equity, so that they treat you more favorably than they would treat a company that is not paying attention to their poor performing assets. Makes you, if you were the debt holder or the equity holder, makes you feel more comfortable that the money that you're putting in is going to be well managed and is likely to give you a result. So once you do that, then you go issue your debt and your equity. I have issue debt, issue equity in order here. That's not always the case, but companies generally, you'll see, will use debt whenever they can. And so a lot of times you will do the debt issue first. and then do the equity issue. So, next sort of question then that really comes from this, we want to think about the factors that are involved in a firm's decision regarding the proportion of its funding that comes from debt versus equity. So, what's that mix? And what I really want to focus on here, again, remember that sometimes you don't have choices. We're not talking about those instances. We're talking about in instances where the amount of funding that you need total is less than the amount that you could raise combined through debt and equity. And so how do you decide what mix? And so when you have an actual decision, I want you to start thinking about why a firm would choose debt maybe over equity and under what situations. And at what point might a firm limit its use of debt? And then kind of what's the theoretically ideal capital structure for a firm? Capital structure is the term that we use to refer to the proportion of debt versus equity that funds the business. So let's start with our funding choices. Assuming you have poor quality or non-performing assets that can be sold to raise funds, you always sell those assets first. That's your first best source of capital. Any remaining funds need to be met through debt issue or equity issue. So that leads to the question, how do you decide between debt versus equity funding? And I'm going to give you this. It's the absolutely earth-shaking answer to this. Start with the least expensive funding option on an after-tax basis and use that first and then go to the next. And so subject to any contract limitations, debt is usually the least expensive funding option. I say subject to contractual limitations because sometimes your debt agreements limit the amount of debt that new debt that you can raise, even though it's the least costly option. You can only use it up to a point before you have to start raising equity. So let's talk about the debt financing. In most cases, debt is the least costly funding source or less costly than equity because, number one, it's less risky. Remember, debt holders get paid before equity holders. And so there's less likelihood that they're going to not get paid. If I'm going to get paid before the equity holders, then there's some chance that as I'm getting paid, we run out of money before we get to the equity holders. So I have a much better chance of getting paid something and a good chance of getting everything, and then the equity holders get what's left over. So in any sort of situation, I feel like I'm less risky. The interest paid on the debt is also tax deductible. So on an after-tax basis, we're not just paying the amount that we give to the investor, we're actually getting a tax benefit. So let's just use an example here. Let's assume a 25% tax rate. And so if before tax the cost of equity is 15%, then after tax it's still 15%, because I don't have a line item in the income statement where I get to take off the cost of equity when I figure out my taxes. With the cost of debt, my before tax might be 10%, but on an after-tax basis, because I get to take that interest expense and stick it into the income statement and deduct it off before I figure out my taxes are smaller. And so on an after-tax basis, if I just said, let me say I do the debt versus I don't do the debt, on an after-tax basis, it winds up only costing me 7.5%. So let's just use an example of kind of that. So, and apologize, I'm not going into a lot of detail on this, but you can sort of calculate out that after-tax cost of debt. We discussed that a little bit before. But so imagine a firm needs 50% or $50 million, and they decide to do 50% from debt, and so 25 million is going to come from equity. So 50% debt, 50% equity, so 25 million from each. And let's just assume that they generate a profit of $5 million. All right, and so that is based on the idea that incorporates the interest charge from this 50% debt. All right, so the return on equity is $5 over $25, $5 million over 25 million, 25 million being the equity. Remember, return on equity is just profit divided by equity, so about a 20% return. Now let's take that same firm, again, needs 50 million, but it gets 80% of that from debt, so only 10% of it comes from equity. Again, they would generate a profit of 5 million less whatever the cost of the additional debt is. The additional debt is $15 million, right? Because they had 25 million in debt. At 50%, at 80%, they would have 40 million in debt. So 15 million is just 40 million minus 25 million. So they have an extra 15 million in debt, and they're going to do that at a 10% interest, but at 7.5% after-tax cost. So their profits are reduced by 7.5% times 15 million, or 1.125. So instead of 5 million, they only have 3.875 million. Okay, so their profits are 3.875 million. Once you back out this extra interest on an equity of only 10 million, they now have a return of 38.75%. So they've almost doubled their return on equity by using debt instead of equity in this. That's why people like using debt. All right, that's why equity investors, remember, the equity investors, the board of directors, they technically own and run the company. They tell management what to do, and that's why it is those shareholders, those equity holders, that oftentimes will say, well, I think you need to do more financing with debt, because that raises our return on equity. So it is possible, though, for a firm to use too much debt. So remember that one of the things that existing debt holders may do as your bond issue goes out, they may say, we're not going to pay as much as you want us to pay for that debt issue or that bond issue, unless you put some sort of a clause in your agreement that says that you won't then turn right around and issue a whole bunch more debt. And usually that takes the form of some sort of a debt to equity ratio or a debt to asset ratio, where there or a liquidity ratio. There's a lot of different ways you can do that, but that sort of says, as you raise future monies, you won't exceed some proportion of debt. And then, so the potential purchasers of the debt may be so concerned with the firm's ability to service debt, if you start taking on too much of it, that they, number one, could just demand a higher return, right? So their risk of not getting paid goes up, which means that they have to demand a higher return on their equity. And at some point that becomes possibly, theoretically, more expensive even than the return that equity owners are requiring. Usually you're talking about firms that are using 80-90% debt when that happens. And to be honest with you, conceptually, it's hard to imagine how the equity holders wouldn't also be demanding a much higher return after that. But the theory says it's possible for this to happen. In reality, what typically happens is that the debt holders simply stop purchasing debt. And so at any price, they're not going to buy the debt of the company. And so the company just is sort of shut out of the debt market. Now, keep in mind that one way that this happens, obviously, is that the company just keeps borrowing and borrowing and borrowing. The other thing that could happen, though, is it's not that the company keeps borrowing, it's that the company is not performing well. And so its profits are falling, its ability to service its debt and have something left over as profit gets smaller and smaller and smaller. And so that can also cause debt holders to basically be concerned about this. And so sometimes, firms will, when the economy is doing well, they'll add a bunch of debt, and then they will find themselves in a bad situation when the economy goes into a slowdown. And as a result of that, what a lot of companies do is basically say, well, we need to maintain the level of debt that will still work when we go into a slowdown. Now, other companies they're more aggressive about that, and they will take on extra debt during the fast economies and then pay down that debt as the economy moves into a recession and try and manage it that way. but it's not uncommon for some companies to just simply say, look, don't decide on what counts as too much debt based on the good times. Figure it out based on what the bad times will be. So, just kind of thinking about, in theory, what might happen in a situation where the debt is more expensive than the equity. Consider, again, our first example where you had a 20% return on equity. And now, let's just say that because of the riskiness of the company or the financial conditions or whatever else, the cost of debt on a before-tax basis went from 10% to 30%. So on an after-tax basis, it's at 22.5%. In this case, the extra debt that you take on, going out and getting that extra debt, is going to cost you $3.375 million extra. And so you had $5 million, you're taking 3.375 off, you only have 1.625 left. So you're making 1.625 million of profit against 10 million of equity. You've gone down from 20% to 16.25%. And so very simply, mathematically, that could be an example, right? In that case, again, don't think of it in that situation as, oh, the equity investors don't want more. It's more that the equity investors aren't going to get more. So if the debt is too expensive, it starts to eat away at the profits that are available to return to equity, and so they're in a worse situation. So how do we strike the balance? Well, theoretically, at any point in time, we would say that the balance should be that whenever we go out to get financing from the market, that we would take on debt until the point that it becomes equally expensive, really not more expensive, but equally expensive to equity on an after-tax basis. And so if we do that, that's supposed to maximize our return on equity. And then after you get that much debt, you take the remaining funds in equity. In practice, I think you're going to find that, number one, most firms don't do that, and quite frankly, it's sometimes a little hard to think in terms of that for a lot of reasons. One is you're talking about the average cost of debt going up rather than the incremental cost. Keep in mind that just because we go out and raise a new issue of debt, that doesn't automatically raise the coupon payments that we have to make on any existing debt. But also, as I said, there are many firms that they don't think about what's too much debt in terms of what's too much debt during the good times. They think about what too much debt would be during the bad times. And so for a lot of situations, when the economy is just doing okay or doing very well, it looks like they don't have nearly as much debt as they could have. But that's because they're planning for the bad times, and they recognize that potentially is too much debt for the bad times. So at the end of the day, what I would say from a capital structure standpoint is we do have some theory that tells you how to think about what the ideal balance between debt and equity is. In practice, there are a lot of practical considerations that go into it that would make it actually very hard to number one, settle on a particular mix, but even to justify pushing yourself to the point that the theory says. And so if you were to go look out in the economy, just look through, say, the S&P 500, I think you would find that for most firms, their marginal cost of debt is, after tax, is still substantially below what their cost of equity is based on maybe a CAPM calculation or something like that. So I know that's a lot, but I wanted you guys to have some notion of the things that companies think about and that you should think about when you're going out and trying to make this decision between debt and equity. Hopefully that's helpful. Thanks.